So now we are at the last paper of our conference, and we have Xing Huang, who's gonna talk about leveraging overconfidence. The discussant is Karabulut, so you have 20 minutes and then 15 minutes for the discussion, please.
Okay, thank you. I was trying to find where can I unmute myself. Thank you so much. Thanks, Anders and Paulo, for putting the paper to the program. Glad to be here, and thank you all for sticking around for the last paper. I'm Xing Huang from WashU. This is a paper joined with Brett Barber from UC Davis, Jeremy Ko from SEC, and Terry Olin from UC Berkeley. So Jeremy is from SEC, so the usual SEC disclaimer applies, or the views are our own. So we study overconfidence in this paper. Psychologists and economists have been studying overconfidence for many, many years. It's perhaps the most important bias to which human judgment is vulnerable. So there are many examples that overconfidence could influence behavioral choices in profound ways. And in the domain of investors' trading activities, we know theoretically overconfident investors would trade too aggressively, diversify less, and perform worse. And consistent with these predictions, empirically, many studies find that retail investors perform poorly and trading hurts their performance. So now what we are going to do in this paper is just to add leverage to the picture. Although trading volume and diversification have long been discussed in the literature, the use of margin actually has been, we think, like relatively underexplored. So under a typical model setup here, if investors receive a noisy signal regarding asset value, we have well-calibrated investors who know the precision of the signal, so they know how they actually do. And we also have overconfident investors who would overestimate the precision, so they think they know more than they actually do. So now if they have budget constraints, and we also allow them to borrow through margin, intuitively what we would get is that the more conditional on skill, the overconfident investors are more likely to use margin. And in other words, the perceived skill rather than the actual skill matters for the use of margin. And similarly, we would expect overconfident investors trade more and speculate more. And because of their mistaken beliefs, their choices are suboptimal, and then their performance would be worse. So basically in this paper, we start off by looking at how overconfidence relates to margin investors. So here we're going to use the data from FINRA surveys to measure individuals' overconfidence and also their self-reported use of margin. And we find that margin investors are more overconfident than other investors. So this is consistent with overconfidence story, but not the information-based story. And then we use brokerage data to study how use of margin relates to other trading activities. So here we find that margin investors, indeed, they trade more and also speculate more. So we would think this evidence actually can be driven by both overconfidence and also superior information. So this is consistent with both stories. So to further separate these two stories, we then look at investors' performance. So if the use of margin is driven by information, we would expect higher performance of the margin investors. However, not only we didn't find margin investors perform better, but maybe surprisingly to the opposite, we find that margin investors, they actually perform worse. So this is kind of consistent with the so-called Dunning-Kruger effect, which I think Anders also mentioned yesterday. He has a paper with David Robinson that documents systematic overestimation among the unskilled ones. So taken together, our results support the overconfidence motivated margin use. In other words, we show that perceived skill matters for individuals' use of margin, and there is a discrepancy between the perceived skill and the actual skill among the margin investors. So just to clarify, we are not saying that all investors are overconfident, nor that only the overconfident ones use margin. What we are trying to say is that overconfidence can increase the use of margin, conditional on the same level of skill. And also overconfidence motivated margin use likely hurts performance in the sense that leverage would magnify investors' losses incurred from trading based on mistaken beliefs. So we think the use of margin is kind of underexplored in the literature, and given its special feature and increasing popularity among the retail investors, understanding the impact of overconfidence on the use of margin is quite important. So from the market participants' perspective, we can see that it may be wealth damaging and create welfare loss. And even though we only study retail investors here, who are more likely to be overconfident, but note that not all institutions or sophisticated agents would be well calibrated. So think about the collapse of LTCM. So these bias actually may affect a broader population. And from the aggregate markets perspective, overconfidence might magnify the influence of those with biased beliefs on asset prices. So it may fuel the bubble, and then the deleverage induced sales may create a market crash and contagion. So it may have catastrophic impact on the aggregate market. And especially we think this is quite important during the time now when we are experiencing the recent surge of disruption of retail trading. So some of the fintech firms have been quite successful using this freemium business model. So when we think about Robinhood, they make all trades free. They actually also made leverage much more easily accessible to the masses, so that the company could monetize from the interest on margin trading. So that brings the recent increase of popularity in leverage among the retail investors. I guess you probably got a glimpse of that from Cameron's talk described about what happened in 2015 Chinese market. So we think it's really important and at the same time quite timely for us to better understand how the increased access to leverage would interact with individuals' most prevalent behavior bias, and what may be the potential dark side tainted on the rosy picture of democratizing access to stock markets. So now let's dive into the details. The first thing we're going to look at is, does overconfidence affect margin use? So here we're going to use the data from the survey. In 2015, FINRA conducted a state-by-state survey on investors' financial and investment knowledge. So this is a nationally representative sample which covers more than 27,000 Americans. This data will be used to measure overconfidence. And then there is a follow-up investor survey, which covers a much smaller sample, but allows us to identify the margin use of the investors. So at the end, we have about 1,600 investors in our sample. To measure overconfidence, we rely on two measures. So the first one is the investor's self-assessment. So on a scale from 1 to 7, where 1 means very low and 7 means very high, how would you assess your overall knowledge about investing or your overall financial knowledge? So that's the first measure. And the second measure is investors' knowledge. And this is basically just their scores from two quizzes, one about their investment knowledge and the other about financial knowledge. And then we normalize these two measures to the same scale and then take their difference. So basically the overconfidence measure is self-assessment minus knowledge. So as many of you are very familiar with the overconfidence literature, there are 3 types of overconfidence: overestimation, overplacement, and overprecision. So basically we're measuring overestimation here. In terms of margin use in the sample, here's a breakdown. So in our sample, we could identify 37.2% investors with margin accounts, and about 18% have margin trading experience. In other words, among the investors with margin accounts, about 48% have margin experience. So all these numbers will just serve as the baseline when we talk about the magnitudes. So now plotting the knowledge and self-assessment by different types of investors here. From left to right, you see the cash accounts and then margin accounts without margin trading experience, and then the ones with margin trading experience. So all the light bars are self-assessment and dark bars are the actual knowledge measure. So clearly what we see from here is that the margin use actually positively relates to self-assessment. You see the light bar actually is increasing from cash account to margin trading experience. In contrast, knowledge actually does not positively relate to margin use. If anything, we actually see investors with margin trading experience have less knowledge than investors with cash accounts. So in other words, whether you use margin or not, does not depend on how much you actually know, but depends on how much you think you know. Given the same level of knowledge, more overconfident investors are more likely to use margin. So to show this more formally in the regression framework, we're going to regress a dummy of margin account on overconfidence as well as knowledge. So looking at the column 2 here, conditional on knowledge, overconfidence is significantly positive. So that's exactly what we would expect when the perceived knowledge rather than the actual knowledge affects the use of margin. So in terms of magnitude, one standard deviation increase in overconfidence here increases the probability of having a margin account by 16.2 percentage points, which accounts for about 44% increase relative to the baseline, which we think is quite sizable. And now zoom in with into the investors with margin accounts, we further look at how their margin trading experience affected by overconfidence. So what we see from here is that overconfidence is significantly positively related to margin trading experience. And the magnitude is also pretty sizable. So one standard deviation increase in overconfidence accounts for the increase of the margin trading experience by 24% relative to the baseline. So this is the first analysis shows supportive evidence that overconfidence matters for the use of margin, and conditional on knowledge, investors who are more overconfident tend to use margin more often. So now let's move on to the next set of results using the brokerage data. So the brokerage data is the one with trading records of 78,000 households from 1991 to 1996. So this has been used in a lot of papers, Terry and Brad's papers and others papers. We focused on the subsample of non-retirement accounts here, and we would limit the sample to the ones we can identify only one type of account between cash and margin. And we also require the households have at least one trade during the sample period. So one thing I want to note is that we actually do not directly observe margin experience. The way we try to identify margin experience is through whether the households had shorted in the past or used options. So within our brokerage data sample, we have about 66% households with margin accounts, and 13% have margin experience. So the breakdown is kind of similar to our survey data. So now let's look at how use of margin relates to trading activities. So here are the two dimensions we consider. One is the monthly turnover, and the other is the speculative trades. The green bar is the cash account investors, and the purple is the margin account investors without margin trading experience, and then the red bar is the ones with margin trading experience. So what we see from here is clearly there is a monotonic pattern. Investors with margin trading experience, they trade more and speculate more than investors with margin accounts but without margin trading experience, and both of them trade more and speculate more than their cash account investors. And running this in regression framework, after controlling for investors' demographic information, we find similar results. So basically, there are two coefficients on both margin account dummy and also margin experience dummy are positive and statistically significant. Also, I want to mention, we also observe a similar pattern for the disposition effect. The individuals who have margin experience or margin accounts exhibit a stronger disposition effect than the cash account investors. So as we mentioned before, this pattern that margin investors trade more and speculate more actually can be consistent with both overconfidence and information story. Because a well-calibrated investors with more precise information could also use margin more often and at the same time trade more and speculate more. So next, to separate the overconfidence from the information-based story, we want to look at investors' performance. So if the use of margin is driven by overconfidence, we would expect the performance of margin investors would be either lower or similar to the ones with cash accounts. So we're going to measure investors' performance in two ways. The first way is on event time. So we calculate market adjusted return for buys and sells separately on different horizons. And then we would construct a long-short portfolio to mimic the trades of investors on calendar time. So looking at the performance for buys and sells separately here, for the buys, what we see is that cash investors lose 42 basis points in 4-day horizon after buying a stock. Margin account investors, their buys perform slightly better, but kind of marginally significant. However, when we look at sales, so cash investors lose 72 basis points following their sales, and margin account investors perform significantly worse. And investors with margin trading experience perform particularly bad on their sales. So combining this buys and sells together, we could see margin investors will earn much worse returns than cash investors. And the results actually look pretty similar when we use longer horizons and also controlling for other things like skewness. So basically what this says is that investors perform poorly in general, both on their buys and sells, but margin investors perform even worse, and the worst performance mostly comes from the sell side. And if we construct a calendar time portfolio to mimic investors' trades, we also see investors have bad stock selection skills. So the buy mimicking portfolio earns negative returns, while the sell mimicking portfolio earns positive returns. And the long short portfolio will lose about 25 to 35 basis points per day. Just to see the comparison a little bit easier in this graph. So again, in general, we can see investors, they have poor performance. So the long short portfolio plotted here or have significantly negative returns. And the investors with margin experience, which is shown by the red bar, they perform even worse than the other two groups. So this evidence is not consistent with the information-based story, because we would expect better rather than worse performance in the margin trading experience group. In other words, this evidence actually more aligned with the overconfidence story. And I should point out that all the returns here are unlevered returns. So it's a little bit to our surprise that we actually find worse unlevered returns in the margin experience group. So to some extent, as I mentioned, this is consistent with the well-documented Dunning-Kruger effect, and also I think in Andrews and David Robinson's paper that the systematic overestimation exists in the unskilled investors. So having said that, even if we find no difference in the unlevered returns across these groups, we could still rule out the information story and support the overconfidence story. And given retail investors perform poorly in general, the use of margin would actually hurt investors in the sense that it will result worse levered returns because the loss will get magnified by the margin trading induced by mistaken beliefs. Perfect. So that's all what I got. The main takeaway is that overconfidence also plays a very important role in inducing margin trading. So we use both survey data and brokerage trading data to empirically establish the impact of overconfidence on the use of margin. So although leverage may improve market efficiency when used by informed and well-calibrated investors, it might hinder the market efficiency when investors leverage their mistaken beliefs. And it may also have negative impact on investors' wealth and welfare. So I think we may want to be very mindful about these potential consequences when we democratize leverage for the masses. So that's all what I get here. Thank you so much. And I really look forward to Yigitcan's discussion.
Thank you very much. John, the floor is yours. You have 15 minutes.
Okay, sir. All right, so good afternoon. First of all, I would like to thank Anders and Paolo for asking me to discuss this very interesting paper. So overall, I think it was a very nice read, which made me think more about, margin trading and how it may affect individual investors. So I would like to first, begin my discussion with providing a little background on this topic. So as you may all know, there is a well-established theoretical literature that shows that behavioral biases, particularly overconfidence, can lead investors to undertake speculative trades, which is supported by the empirical evidence, do not necessarily benefit the individuals. So on the contrary, the data show that excessive speculative trading actually lowers the risk-adjusted returns as well as the welfare of individuals. So among potential drivers, in practice, investor leverage has been argued to represent an important driver of speculative trading, mainly because leverage allows investors to take larger positions than what they would otherwise can afford. And at the same time, it increases the scope for extreme returns. Now, given the negative implications of speculative trading, both at the individual but also at the aggregate level, as mentioned by Xing, it is obviously crucial to understand, both from an academic but also from a policymaker perspective, the economic forces underlying speculative trading of speculative behavior of individual investors and how it interacts with investor leverage. So in this sense, I think Xing's paper addresses a very important and topical question with potentially very important policy implications. Now, given this background, in this paper, Xing and her co-authors focus on investor overconfidence as the key underlying mechanism and investigate both theoretically but also empirically the relationship between overconfidence and use of margin accounts and their implications for trading behavior and portfolio performance of individual investors. So let me just very quickly summarize what they find. So first, using survey data, the authors document a positive relationship between investor overconfidence and use of margin accounts, which is also robust to controlling for several relevant investor characteristics. Now, once they establish the link between overconfidence and margin trading or margin use, then using administrative data from a large US brokerage firm, they further analyze the trading behavior and portfolio performance of these investors and find that investors who used margin accounts that they proxy by short selling or option trading significantly trade more and engage more in speculative trading, both of which actually hurt their portfolio performance. So overall, the results suggest that the combination of overconfidence and leverage can be detrimental to individual investors. I have I have three sort of main sets of comments and suggestions. So my first comment concerns the question of who borrows on margin and why do they do so. So obviously, the first part of the paper, as Xing described, partly speaks to this question, but I think the paper can significantly benefit from a more elaborate discussion of this issue, as there appears to be some quite interesting, at least to be some unexpected patterns. Now, maybe just to put things into perspective, according to the survey evidence, approximately 10% of the overall population have a margin account, and conditional on having such an account, almost half of them have used margin account. So overall, the margin account users correspond approximately around 1/20 of the overall population, which is a quite sizable number. Now, in the data, when you look into the characteristics of the margin traders, I think as I mentioned, some interesting patterns emerge. For example, as shown in the descriptives, the investors who have used margin accounts on average score significantly lower both in financial literacy, but also in investment literacy as compared to those investors who have only a cash account or who have a margin account, but no experience using them. So I find this result quite interesting, but also a little puzzling, because the margin investors are the investors who are more likely, say, to invest in more complex financial products such as options or other derivatives, as well as follow maybe more advanced investment strategies such as short selling. So this is one thing. In addition, most brokerage houses actually require their clients to have a certain level of knowledge and trading experience even before they approve the opening of such accounts. So a priori, I would have expected the margin traders to be more sophisticated ones, but actually the data show exactly the opposite. So I think this is very interesting. Another issue is that, related issue is that in the multivariate analysis, the sign of the literacy variable reverses, once the authors control for investor overconfidence and other characteristics. So given that the investor overconfidence variable is defined as the difference between the self-assessed knowledge and the objectively tested knowledge, maybe I was wondering there might be maybe something mechanical going on here. But in any case, I think this is a very, it will be very useful to discuss this issue more in detail, because it is going to be quite important when we think about the potential policy implications of this paper, which I will talk at the end. Another interesting feature of the margin traders is that they tend to be on average wealthier. So this is also interesting because, in theory, I would have expected also thought that maybe overconfident investors with budget constraints may rely more on leverage and using margin borrowing. But again, the data show the opposite. So I believe, a further examination of this issue could be, very useful and interesting. So what I'm, sort of thinking is, for example, in the brokerage data, the authors can analyze whether, the investors who are using the margin accounts to also have any, say, positive balances in cash or cash equivalent financial products. So what I have in mind is, if they do have, say, large cash balances that earn lower returns, but still use relatively expensive and risky margin accounts, which have an APR of 8, then this can be considered as a puzzle, which might be even analog to the credit card debt puzzle. So if this should be the case, then some of the explanations that we know from the literature for credit card debt puzzle, such as timing mismatch, precautionary behavior, the need of liquidity may also apply even to margin borrowing. So overall, I think understanding the potential motives of the investors why they use these accounts could be a very novel and a useful exercise. Then in the second part of the paper, the authors show that investors who have used margin accounts significantly trade more and engage more in speculative trading. So in this analysis, they estimate cross-sectional regressions, where they regress, say, the mean monthly turnover on having or using a margin account and other investor controls. So obviously, because of standard econometric problems, causal interpretation of these estimates may be subject to some limitations. So here, what I would maybe recommend or suggest to authors is, in order to strengthen the evidence provided in this section, they may want to exploit the time dimension of the data, especially of their brokerage data, and they may focus on the sample of individual investors that switch from having no margin account or using no margin account to having one or using one during the sample period, and compare the trading behavior of the switched group to the group of no margin account users or holders, both before and after the switch. So here, a significant increase in the turnover or speculative behavior of individual investors after, once they open up this account or use these accounts, could provide a more, causal interpretation of the effect. On a side note, I think also a potentially interesting issue is, given that margin accounts require a higher level of attention, including potentially monitoring stock prices on a daily basis, I think such an analysis, where you exploit the time dimension, can also contribute to understand the potential pathway or the mechanism through which margin borrowing can lead to, say, excessive trading. So what I have in mind here is that there can be an additional layer which is yet unexplored, and that is, let's say, the increased investor attention. So what I'm thinking is maybe increased attention that is triggered by borrowing on margin can amplify the negative effect of behavioral biases, in this case, investor overconfidence, and can lead to, say, excessive trading, can lead to a more speculative trading, which at the end, will hurt my portfolio performance. Okay. In addition, I also, find the results on the speculative trading very interesting, and I will also encourage the authors maybe to analyze this issue more in detail. For example, the theory should suggest that speculators that use leverage tend to bid for an asset, and such an bidding activity drives up the asset's prices, which in turn attract more speculators, creating a positive feedback between leverage and speculation that can even lead to creation of bubbles. So accordingly, I was wondering whether the margin account users also, say, tend to hold more overpriced, possibly mispriced, but possibly overpriced stocks. So if I'm not mistaken, the brokerage data should provide security level information, and combining it with the, say, mispricing measure of Stambau and his co-authors, one can maybe directly test this. Another similar issue is, I think it will be also interesting to understand or to study whether the margin account holders also tend to invest more in, say, high risk stocks, which are also tend to be overvalued. Stocks, say, with high beta, high IWOL, but also with high lottery payouts. Finally, maybe another related issue is the performance aspect. So as I mentioned, the margin account users underperformed other investors, and of course the authors I think correctly emphasize the excessive trading and associated trading costs as the key driver of this underperformance. So again, if I'm not mistaken, the data should also provide some information about trading costs. Even if not, maybe using some back of the envelope calculations, the authors may want to quantify the relative contribution of trading costs to the observed underperformance, so that it would be nice to say something like X% of the trading losses can be attributed to transaction costs, in order to understand the magnitude of the, in order to understand the sort of contribution. And finally, as I mentioned, I think the paper has important policy implications, which should be, I think, more prominently discussed in the paper. So when we think about the key message of the paper, again, that is the combination of overconfidence and leverage is detrimental to individual investors, then a natural question that sort of arises is, how can we prevent individuals then, from hurting themselves? Okay, so obviously, there are several potential, policy measures that can be proposed or imposed. Maybe one possibility might be to impose more strict financial regulations also in the common stock trading, similar to the retail FX market. But given that there's already a restrictive leverage policy in stock trading, I think such actions might be less effective. A more extreme policy measure might be even to ban the use of margin accounts and to ban such products. So even though this sounds also quite extreme, in Belgium, for example, since 2016, there is a ban on the use of some leverage products for retail investors. And finally, also it goes back to my initial comment about who trades on margin. So if indeed the margin borrowers or traders are indeed financially more illiterate, then financial education might be the appropriate policy so that investors can understand the associated risks better. Okay, so these are some further thoughts about the implications of the paper. So just to conclude my discussion, so I think this is a very interesting project with potentially important policy implications. I really enjoyed again reading this paper, and I very much looking forward to the next version. So thank you.
Thank you very much, John. So before I let Xing to respond, we actually have a question in the chat. So I would encourage Cameron to actually pose it directly.
Sure. It's a question that's sort of like a alternative story. Just wondering if like a gambling preference or prospect theory could also sort of explain the results between the take-up of margin account and subsequent sort of suboptimal performances later. Because gambler, I mean, they overestimate the upside, and then that makes them prone to sort of open up a margin account. But then that may also sort of induce them to buy like lottery-like stocks, like IPO stocks or distressed stocks. So, I mean, I think you can sort of take a look at the stock characteristics, sort of portfolio characteristics of these different types of investors, just to sort of entertain with this kind of alternative explanation.
Yeah, so that is a great question. And actually, that is something we recently explored, haven't really added in to the newest draft. So exactly as you just described, gamblers, they probably are more likely to use margin, and also the skewness kind of negatively predict future return, and that can be an alternative story. And we actually had designed some tests to control for the skewness, and the results are quite robust to that. So I think that is a very good comment. So glad we already addressed that. And I think that also kind of related some of Yigitcan's comments, I think related to how can we establish a stronger causal relationship. So you had a few very good suggestions there. Some of the things related to time dimension, maybe because the data limitation, we kind of cannot explore like the margin and cash account. We actually only observe that characteristics is not time varying in the data set, but I think some of the things along the line we can think more tests to address that. We actually discuss some experiments and then try to establish a causal relationship. So that's also in discussion. And also, I really want to thank your very helpful and constructive comments. So as you mentioned at the beginning, there is this very interesting, I think, evidence that the margin trading experience group actually have a kind of lower literacy. I think that also echoes to the evidence I pointed out. The margin trading experience group, they also have a worse unleveraged return. So that is not what we designed to test, but that's some kind of byproduct coming out from the evidence. And I think also related to Andrew's paper, and also this Dunning-Kruger effect, I think is quite fascinating. And also, I really like the policy implication you discussed at the end. Definitely, we want to make this more impactful and think more on that dimension. So thanks for all the suggestions. Thank you everyone for sticking around. Thank organizers for organizing such a wonderful conference. And I will leave that to you too.
Perfect. Thank you so much. Okay, so here we are.
Yeah.
So it's the
How shall we celebrate?
Well, first of all, it's the end of the kind of normal official time, but you are more than welcome to join us for this breakout room. The link is in the chat, and I really hope to see you there. It's actually, so far we have learned it's quite a lot of fun. In fact, it's difficult to get people to talk about research. So hopefully we'll see you there. And we would like to thank everyone for this great conference, for presenting their papers and for discussing them. It has been fantastic, really.
I learned a lot.
Yeah, me too. I don't know if you want to say anything else. That's it.
No. Thank
Okay.
you all.
Thank you.
It was great.
Bye-bye.
Hope to see you at IRL soon.
Exactly. Bye-bye.
Bye.